In this chapter, the author explores the concept that nothing in life is free and that everything has a price. They use the example of General Electric once the largest company in the world, to illustrate this point. Its downfall during the 2008 financial crisis was attributed to poor leadership and risky investments. The author emphasizes that it is easy to criticize and think we know better when we are not the ones facing the challenges firsthand. The author then applies this concept to investing. They highlight the fact that successful investing requires paying a price, which is often overlooked until faced with volatility, fear, doubt, uncertainty, and regret. They caution against trying to get something for nothing in investing, as it rarely ends well. They use the analogy of wanting a new car and the options of paying for it, finding a cheaper used one, or stealing it. Similarly, they argue that earning a high return in investing also comes with a price, and attempting to avoid volatility and uncertainty is like trying to steal a return without paying the price. The author discusses the performance of tactical mutual funds and individual investors who try to avoid paying the price of volatility. They find that these strategies often result in underperformance and higher risk. They also highlight the example of former CEO Jack Welch, who manipulated earnings to create the illusion of consistency and predictability. However, when the bill came due, GE shareholders suffered significant losses. The author concludes by emphasizing that the price of investing success is not immediately obvious, and that viewing market volatility as a fee rather than a fine is crucial. They compare market returns to the cost of admission to Disneyland, where the fee is worth paying for the experience. They encourage investors to find the price of investing and be willing to pay it, understanding that there are no guarantees, but that it is the only way to potentially achieve greater returns. In this chapter, the author explores the reasons behind financial bubbles and why they continue to occur. While many people attribute bubbles to greed, the author argues that it is not that simple. People make financial decisions that may seem gritty in hindsight, but at the time, those decisions made sense to them. Bubbles are difficult to learn from because they are not like cancer, where there is a clear warning and diagnosis. They are more like the rise and fall of a political party, where the outcome is known in hindsight, but the cause and blame are never agreed upon. One reason bubbles occur, which is often overlooked, is that investors innocently take cues from other investors who are playing a different game than they are. Different investors have different goals and time horizons, which means that what may seem like a ridiculous price to one person can make sense to another. Bubbles form when the momentum of short-term returns attracts enough money that the majority of investors become short-term traders. This shift in investor makeup leads to bubbles, as short-term traders focus on short-term gains rather than long-term valuations. The author uses examples from the dot-com bubble and the housing bubble to illustrate this point. During the dot-com bubble, many investors had short time horizons and were focused on day trading and short-term gains. The same was true during the housing bubble, where many people were flipping houses for quick profits. These investors were not concerned with long-term valuations or income growth. They were simply focused on short-term price movements. The problem arises when long-term investors start taking keys from short-term traders. Long-term investors may see short-term traders driving up prices and think they may be swayed by the actions of people playing a different game and make decisions that are not in line with their own goals and time horizons. The key takeaway from this chapter is the importance of understanding your own time horizon and not being swayed by the actions of others playing a different game. It is crucial to identify what game you are playing and make decisions based on your own goals and objectives. By doing so, you can avoid being caught up in the frenzy of bubbles and make more informed financial decisions. In this chapter, the author explores the seductive nature of pessimism and why it often holds more appeal than optimism. The chapter begins with a story from 2008, when the global financial crisis was at its peak. The Wall Street Journal published an article by a Russian professor predicting the breakup of the United States into 6 pieces. This story gained significant attention despite its outlandish nature. The author argues that pessimism sounds smarter and more plausible than optimism, and people are more likely to pay attention to negative forecasts than positive ones. The chapter goes on to discuss the reasons why pessimism is so captivating. One reason is that bad news tends to affect everyone and captures everyone's attention, while good news is often overlooked. Additionally, pessimists often extrapolate present trends without considering how markets adapt. The author gives the example of a prediction in 2008 that the world would run out of oil by 2030. However, markets adapt and new technologies, such as fracking, can change the outlook dramatically. Another reason why pessimism is so appealing is that setbacks happen quickly and capture attention, while progress happens slowly and often goes unnoticed. The author gives the example of the invention of the airplane by the Wright brothers. It took years for people to recognize the significance of their achievement, while a single plane crash would immediately grab headlines. The chapter concludes by emphasizing the importance of paying attention to the price of success in investing, which includes volatility and loss amid long-term growth. The author also shares a quote from scientist Stephen Hawking, who said that his expectations were reduced to zero when he was 21, so everything since then has been a bonus. The author suggests that expecting things to be bad can lead to pleasant surprises, which is something to be optimistic about. Overall, this chapter explores the allure of pessimism and why it often holds more appeal than optimism. It highlights the importance of recognizing the biases that can influence our thinking and the need to balance caution with a realistic assessment of the potential for progress and growth.